inflation. Here's how I see it. The Fed is always late. They're the last to notice things. When they do something, it's already because everyone has figured out what's going to happen after not seeing the problem coming. And about cutting rates. They claim not to care about politics, but that's nonsense. You can argue both sides. But here's the reality. When they cut rates, and that will happen at some point, it's because we'll be in a recession. That's a fact. And regarding cutting rates, it's an economic warning sign. The Fed doesn't lead. They're always following the economic rhythm. And, as a forecast, their performance is quite poor, just based on that. Now, why is the pivot a good thing? And why is Wall Street celebrating it? If a pivot happens, it's a sign that we're in recession. The White House keeps saying that prices are falling, but that's not true. You might think that some of the 48 components of the CPI are moving, but overall, prices aren't falling. What they really mean, and I don't know if they're confused or just propagandizing, is that the inflation rate is falling. And that's not the same as prices falling. If the inflation rate falls, prices are still rising, right? They just are rising more slowly. So, saying that prices are falling is pure talk, or propaganda, whichever you prefer. And they're not even sure about the other issue, that inflation is falling, because it's actually rising. The peak was in June 2023, when it was at 3%. Then in August and September, it rose to 3.7%, dipped to 3.4%, and now it's come out at 3.1% is greater than 3.0%. Inflation, using the standard CPI, is higher now than it was last June. Therefore, inflation isn't falling. In fact, it's rising. The Fed is losing the battle against inflation. Forget about the talk of pivot and terminal rate. What really matters is that inflation is rising. If you want to be generous and say it's somewhat stable, with some fluctuations, fine. But the truth is it's not falling. Then they remove the core of inflation from the calculation, excluding energy and food. But let's be realistic. Energy and food are the main expenses for most people. And if you include heating and cooling costs, that just adds to the bill. They try to soften the narrative with the super core, excluding energy, food, and housing. But who lives like that? Unless you're living in a tent and surviving on tuna, those costs affect everyone. What people are really paying is the CPI. That's what matters in everyday life. It directly affects how people will vote in an election. I look at the overall CPI because that's what impacts people's behavior. If traditional economists and regional Fed presidents don't want to consider that, the problem is theirs. The price of gasoline and milk you see at the store is the essence of what's happening. And there's more. This inflation is entrenched, even if it were to reach zero, which is not the case. It doesn't mean prices will actually fall. All the increases that have already occurred are embedded in costs. They won't disappear. That still bothers people, even if inflation were to drop, which is not happening right now. We're talking about how price increases enter people's memories. Inflation has a life of its own. It's all about behavior. Deep down, what drives inflation is human nature and behavioral psychology. Expectations are a relevant point, but the issue goes deeper. It also involves the supply chain. We're seeing increases in minimum wages and other issues that are pushing inflation up, regardless of what the Fed does with rates. This may make the stock market rise, but it doesn't impact the real economy. The broader view is that we are in a disinflationary process, perhaps almost bordering on deflation, which is the nightmare of central banks. They claim not to worry about inflation because they think they can just raise rates until it disappears. But deflation, that's where things get complicated. because they don't have a formula for dealing with it. Quantitative easing Q isn't working. In fact, many argue that it's a joke. And when I say that, we need to clarify. There's an abundance of empirical evidence since 2008 in various countries showing that QE doesn't generate inflation. You can debate it to your heart's content, but the truth is it doesn't deliver results. Between the end of the last recession in 2009 and the end of 2019, for example, the Fed's balance sheet jumped from 800 billion to 5 trillion, and the monetary base rose the same way. And guess what? There was no inflation. The average annual growth during that period was 2.2%, well below the potential of 3% to 3.5%. If you're growing at 2.2% while the potential is higher, that's what Keynes would call a depression. And I don't need to engage in debates about recession. I know what they are. Almost 17 years ago, in 2007, we entered a depression, and even Japan is a clear example of this, facing its 9th recession in 30 years. What would you call 9 recessions in that time frame? I'd call it a depression. What truly impacts is psychology, expressed in the velocity of money. You can have hyperinflation with a small monetary base if capital turnover is high, but that's something psychological that feeds on itself. It propagates demand-side inflation more, but supply-side inflation tends to extinguish itself. When prices get high enough, they usually drop again, as people start producing more and there are efficiencies in the supply chain. However, demand inflation doesn't have a natural remedy. It's cyclical and can grow exponentially. That psychological shift you mention is crucial, and I really don't see a clear sign of it at the moment. The velocity of money, which feeds on itself, can generate the inflation we want, regardless of the monetary supply. And geopolitics, well, is a factor that cannot be ignored. The closure of the Suez Canal, for example, changes the dynamics of maritime transport. Ships have to take longer and more expensive routes. This not only increases transportation costs, but also pressures fuel prices and, consequently, affects the sale of various products. Therefore, it's a destabilization of the supply chain, causing inflationary pressure. I agree that we can discuss supply-driven and demand-driven inflation, but at the end of the day, if prices rise, we call that inflation. The real danger is supply-driven inflation leaking into demand. When that happens, expectations change and inflation feeds on itself, leading to a cycle that can spiral out of control. So, my answer is that I do not expect a significant drop in inflation. In fact, I see the possibility of it rising for a few months, especially due to geopolitical factors. And that means we're in a delicate situation, possibly stagflation. If the Fed cuts rates in a scenario of rising unemployment and negative job growth, that would indicate a recession, which is a classic sign of trouble. And there's the issue of real wages. Wage distribution is uneven, and even if you hear that wages are rising, that average may be misleading. The reality is that people at the top, like Jeff Bezos, could be pulling the average up, while most of the population may be facing a real decline in wages. We need to carefully watch these indicators. If unemployment worsens and job creation falls, that's a clear sign of recession. We're really facing it. What we could face, then, is stagflation, which is a feared situation where we have high inflation and rising unemployment. It's exactly what happened between 1979 and 1980 when we faced 10% unemployment and 13. This scenario questions the validity of the Phillips curve. The Phillips curve, which suggests an inverse relationship between inflation and unemployment, seems not to have corrected when we look at these data. In other words, we can observe high inflation rates accompanied by high or low unemployment rates, which suggests that there is no clear causal relationship. This lack of correlation makes the Phillips curve a less reliable tool than originally thought. You brought crucial points about the Phillips curve and the relationship between inflation and unemployment. Indeed, the events of 1979 and 1980 challenged the traditional notion that inflation and unemployment have an inverse relationship. Even with high unemployment, inflation remained high, raising doubts about the Phillips curve's validity as a predictive tool. Between 2009 and 2019, we experienced a scenario where unemployment fell, but inflation remained low, again challenging the expectations of the Phillips curve. These data cannot be ignored, as they show that economic reality can be more complex than models suggest. As for national debt and its relation to GDP, an important observation. The increase in national debt to 34 trillion, especially with the debt-to-GDP ratio reaching 125%, is alarming. The perception that this doesn't matter, fueled in part by modern monetary theory, is concerning. The comparison with Japan and its 300% debt-to-GDP ratio can create an illusion of safety, but we must not lose sight of the context. I fully agree that high debt numbers need to be analyzed concerning payment capacity. That is, the income one has. If you owe $50,000 on a credit card but are making $500,000, your financial situation isn't that grave. On the other hand, if you're making $220,000 and owe the same amount, the scenario becomes unsustainable. This illustrates that the analysis of indebtedness should go beyond absolute numbers and consider the broader financial context. What we need to look at now is how this debt and its relation to GDP impact the economy, especially in an environment of potential changes in interest rates, persistent inflation, and other economic factors. Undoubtedly, the lack of a debate regarding these critical issues could have significant implications for the economic future. Ultimately, we need to look not only at the numbers but at what they truly represent in terms of economic growth capacity and stability. You raise a very interesting point about the relationship between debt and GDP, especially by mentioning the Kiene multiplier and the idea that debt can, under certain conditions, stimulate economic growth. Essentially, when debt is at a manageable level, as you mentioned, around 30% of GDP, there can be a positive effect on growth, where each dollar spent results in a greater increase in GDP. Historically, during the peak of the economic recovery following World War II, the debt-to-GDP ratio was significantly reduced, showing that it was possible to control debt while promoting economic growth. This was a bipartisan consensus, as you highlighted, and the approach focused more on fiscal responsibility than on political disputes. However, what you also highlight are the diminishing marginal returns as the debt-to-GDP ratio increases. This is crucial. When debt becomes excessive, the positive impact of new public spending tends to decrease. In other words, the same dollar spent generates a smaller return in GDP growth. This can lead to a vicious cycle where the need to finance debt interest begins to overload the government's capacity to invest in areas that truly stimulate growth. With national debt currently at such high levels, the sustainability of indebtedness becomes a critical concern. While it is true that spending can generate growth under certain circumstances, the effectiveness of that spending begins to diminish if not well directed or if debt continues to accumulate at unsustainable levels. Therefore, the challenge we face is finding the right balance. How to efficiently utilize debt to foster growth without exceeding the limits that would make the economy vulnerable. This requires not only a solid fiscal strategy, but also a profound understanding of how different types of expenditures affect economic growth and the well-being of the population. The question becomes even more complex in a global context with geopolitical uncertainties, market fluctuations, and changing inflation expectations. The issue of the critical threshold of debt relative to GDP is indeed a complex and crucial topic for a country's economic health. Based on your observations, it seems there's a growing consensus among economists about the point at which debt starts to be harmful. The idea that the economic multiplier begins to decrease as the debt-to-GDP ratio exceeds certain limits is well documented. Many studies suggest that from a debt-to-GDP ratio of around 90% to 100%, the returns on investments in infrastructure or public spending begin to decline, generating less economic output relative to what is spent. You mentioned that when the ratio reaches 90%, the multiplier could fall to 0.60, meaning that each dollar spent only returns 60 cents in GDP. This is a clear sign that debt starts to become a burden instead of a stimulus. Moreover, the situation is not just about generating GDP, but also about how the debt relates to the country's capacity to grow sustainably. As the debt-to-GDP ratio increases, the economy may begin to grow more slowly, even if there is still some nominal growth. This type of slow growth is problematic, as it complicates the reduction of debt effectiveness and can lead to a cycle of economic sluggishness. The most extreme alternative, as mentioned, is default, as Argentina has experienced due to its inability to finance its debt in foreign currency. The situation there is an example of a scenario where local currency indebtedness becomes unsustainable, leading to recurring crises. Other consequences of a high debt-to-GDP ratio include 1. Elevated borrowing costs. Countries face high interest rates as investors become more reluctant to lend to a nation with high debt levels. 2. Reduced public investment. The need to allocate resources for interest payments on debt can reduce investment in critical areas like healthcare, education, and infrastructure. 3. Impact on fiscal policy. Governments may feel compelled to adopt austerity measures, cutting spending in times of need, which can exacerbate economic slowdowns. Therefore, while high debt levels do not automatically spell financial collapse, they represent a warning sign about economic sustainability. The challenge is to find a balance where debt can be used to stimulate growth without crossing the critical limit where its effects become counterproductive. This discussion is essential to ensure responsible fiscal policy that promotes long-term growth and avoids cycles of debt crises. You provided a very comprehensive and accurate analysis of the options a country may have when dealing with high levels of debt, as well as the risks involved in different financing strategies. Let's delve a little deeper into the three options you mentioned: default, restructuring, and hyperinflation. 1. Default. Default is an option where a country simply refuses to honor its debt obligations. This can be devastating for the economy, leading to loss of confidence from investors and making it difficult to access financing in the future. Countries that have debts in their own currencies have more flexibility in circulating the currency, but those that incur debts in foreign currency, like Argentina, face much greater risks. 2. Restructuring. Restructuring is a more elegant route that the IMF often offers to troubled countries. Instead of declaring a default, countries can negotiate new terms with creditors, such as longer terms or lower interest rates. This can alleviate the debt burden without causing a shock of confidence as deep as a default. However, as you pointed out, for the United States, which can issue currency, restructuring becomes less relevant since the country has the capacity to create money, though this doesn't come without consequences, like inflation. 3. Hyperinflation. Hyperinflation occurs when a country attempts to deal with its debt by creating more money than the economy can bear, resulting in severe devaluation of the currency. This may seem like an easy solution in the short term, but it's a dangerous trap and can lead to a total loss of confidence in the currency, as seen in historical cases like Zimbabwe and Weimar Germany. The modern monetary theory, MMT. The debate surrounding MMT is one of the most controversial today. MMT suggests that a government that issues its own currency doesn't need to worry about debt in the same way that a government that borrows in foreign currency does. This approach argues that deficit financing can be achieved through currency issuance, especially when the economy has idle capacity. However, as you correctly indicate, this view can oversimplify the complexities of currency markets and the factors influencing inflation. Mandel's impossible trinity. You also brought at Mandel's critique regarding the impossibility of simultaneously controlling exchange rates, interest rates, and capital controls. This is a vital consideration in open economies, and can help explain why the effects of monetary and fiscal policy may differ across contexts. This is an aspect often overlooked by advocates of MMT, who may not consider how policy on these variables may influence currency value and, consequently, a government's capacity to sustain high debt levels. Future risks. Thus, while the United States may be in a more privileged position to print money to pay its debts, the consequences of excessive indebtedness and aggressive monetary policies must be carefully considered. The lack of understanding of currency markets and global capital mechanisms can lead to risky decisions. The reality is that in the current scenario, we cannot ignore the long-term effects of debt accumulation and unconventional monetary policies. Ultimately, we need a balanced approach that considers not only the immediate capacity to issue currency and finance deficits, but also the long-term impacts on the economy, inflation, and market confidence. This requires a refined understanding of the global economic dynamics, which seem to be in constant flux. Did you enjoy the video? Leave your like, subscribe, and activate the bell so you don't miss our upcoming discussions on economics and finance. Let's explore together what happens when debt becomes a dilemma.